In today's video, I am going to be breaking down my choices as to what I think will be high growth stocks that pay a fairly large dividend in most cases. These may be quite big surprises to you, while others may not be. So let's get down and let's check these out. I personally feel that some of these are really interesting options. Okay, so first is OpenText. This is a Canadian company that does extremely well in the stock market. It does pay a dividend, but it's not exactly massive at 1.96%, but it is still basically a 2% dividend stock. Its ticker symbol is OTEX. Its volume is pretty big as well. I really doubt any of us are going to be buying 100-something thousand shares when we're buying it anyways, so we're not going to have any issues getting in and out of it. The PE ratio is, in my opinion, high when it comes to looking at dividend stocks. However, it is a tech stock, so in reality, versus other companies in its field, it's about average, if not just a little bit lower. When it comes to their financials and their earnings, revenue and earnings is kind of interesting. So when it comes to their earnings, there really isn't any massive growth whatsoever. Sometimes they'll have a lower year, sometimes they'll have a higher year, and then a lower year, and then a higher year once again. However, what I am looking at is their revenue. Revenue is king. Rev is king. We've learned this in the past. We've learned this if any of us have ever worked retail and you had a manager who was always chasing after his bonuses that they get, then if you've got a manager who's doing that, he'll probably always say rev is king, because usually in most companies, revenue is what they chase, and they get bonuses upon that. Then there's other companies like Best Buy who give their managers bonuses on service plans, warranties, extended warranties, the stuff that is a massive waste of money. Anyways, let's keep on looking at this stock. But anyways, the revenue keeps on growing, and that is promising. Now, what does OpenText do? Well, they engage in design, development, markets, and sells information management software and solutions. It offers content services, business network that manages data within the organization and outside the firewall, security and protection solutions for defending against cyber threats. They basically do everything, really. Over the last 3 months, they have pulled back. However, so has the entire tech market, and now it's gone on to the whole broad market. And there really is kind of an interesting thought process that I have when it comes to the recent pullback, and that is tech started, and now it's come to a broad market pullback. In my opinion, that's going to either go into a massive recession, or really, in my opinion, it's probably going to be just a correction, just what we always get every single year. Usually it happens 2 or 3 times a year, and it usually always starts off with a high growth sector, for example, tech recently, and then it goes to broad market. Usually it's pretty bad for 2 or 3 days, and then it starts coming back. The market will never go completely always vertical. We have to remember that. This is why you want to invest over time. And over the past 5 years, which is where I really like to really look at myself, because at the 5-year period, you're not going to get the skewed information of having a massive pullback here when the virus was going crazy, which I don't know why anyone thought the virus was going to affect tech stocks, but whatever. And then it pulls back, and that's how the numbers are going to be skewed if you don't look at the 5-year. If you look at the 3 or 6 month, that works too really well, because then you can get recent information. But really, it's pulled from 45 to 58. It did have a pullback down to 40, so technically there was a close to 50% growth over the past 5 years if you look at the lowest part. So there's really some nice growth that's historically happened with this stock. I also really like to look at their dividends, see if they're growing. So in December it was 28 cents, December of last year was 26 cents, December of the year before, which would have ended up to be November, was 23 cents. And then the November before was 20 cents. So it is growing year over year. So that's something that we really want to look at, is not just the overall growth of the stock itself, but the dividend too. Now, I'm probably going to pronounce this wrong, but Nutrien is another fantastic company. This one does pay a little bit bigger of a dividend of 2.6% and has huge volume of well over 1 million shares traded, and the PE ratio is not terrible either. Their revenue has been increasing slowly over this last years of time. However, 2018 and newer, older, whatever you want to say, since 2018, their revenue or their earnings have decreased while their revenue has gone up. So it's up to you how you want to really take that. But to me, that is revenue growth, which is positive in my book. What does Nutrien do? It provides crop inputs, services, and solutions. The company offers potash, nitrogen, phosphate, basically fertilizer. And since 5 years ago, it has grown slightly from $70 up to $89 per share. Of course, it did have the rounded top and, of course, the COVID stuff that happened since then. But it has been a nice, really nice. Like, if you really, really, really look at this and you really chart it out, this is absolutely amazing. And this is one of those stocks where it looks like it could potentially break out once again. If we zoom in and we do those lines again, and we do those lines there, and we do another line here, check out how that looks absolutely perfect to break out. If it bounces off this point, there is going to be some growth happening, at least in the close or midterm. But if it breaks below this point, there's going to be potentially some issues. Now, has the dividend been growing? Well, that is a very good question. December is 58 cents. December before was 57 cents, and then it was 58 cents, and then it was 58 cents. So really, in my opinion, the dividend's not really moving all that much, but it is a pretty steady dividend for a company that seems to be growing. And then there's the whole thing when it comes to COVID and the reopening. There's going to be more food that is going to be needed, in my opinion, because there's going to be a lot of people who went crazy about buying food that they didn't need to have because they thought it was the end of the world. There's going to be all these restaurants who need to now not just rehire people, but bring in food because they literally have nothing in their fridges right now because they've been closed on and off for the past 600 and something days. And we are just now reopening once again in Ontario because our government is, I don't know. But either way, it seems to be a nice growth sector in my opinion because I think that crops are going to be very needed very soon. TransAlta is another one that I think, and I've already broken this stock down this month, so I'm going to go over it really quickly, but there's a reason for TransAlta. The reason is because governments around the world, they just want to switch over to electricity, electric cars, and things like that. TransAlta offers, or is at least expanding their ability to have solar farms and wind farms, and they sell electricity. And guess what? There's going to be more and more electricity needed in the future because there's government officials like the idiot that we have in charge who wants to make gasoline illegal. Now, you can have your own thought process on that. It's probably never going to happen, at least for another 20, 30, 40, 50, 60 years, and it better not happen anytime soon because I like my car. But there's going to be more and more electricity needed. There's going to be more computer systems that need electricity. There's going to be more and more potentially Tesla robots that need it. And of course, there's going to be more and more Teslas that are going to be on the road. So because of that, guess what? They're going to need more electricity. They're going to need more infrastructure for the electricity. And that's what TransAlta does. They currently pay a 5.5% dividend. So while you're waiting for the whole electric revolution to happen with the cars, you can gather a 5.5% dividend and use that dividend to buy yourself a replacement electric car. So maybe Tesla might be a great option. But they don't pay a dividend. So anyways, average volume of 450,000 shares per day. I almost said 4,500. That wouldn't be right. But either way, if you look at their earnings, they have been missing their quarterly earnings. Then that just doesn't seem good, right? And then they're also losing revenue and they're also losing earnings. But again, they develop, own, operate renewable power generation facilities. As of March 3rd, 2021, it owned and operated 23 wind facilities, 13 hydroelectric, 7 natural gas, 1 solar, 1 natural gas pipeline, and 1 battery storage, comprising ownership interest of 2,500 megawatts of generating capacity. This right here is what I think is something people need to start investing in Tesla for, because that's what Tesla does. Over the past 5 years, they've had their downturns, they've had the COVID downturn, they've had a ridiculous spike, and of course, they are starting to decline once again. Now, will this be a continuation? Yeah, it just dipped below any kind of support. It's now at lower than that support. So guess what? This could drop a little bit more. However, this could create a lot of good buying opportunities, especially that they pay the exact same dividend for the past, I think it's 4 or 5 years, like many years, and they pay the same dividend every single month. So guess what? This, to me, if we can find a good entry point on this stock, this could be very interesting going into the future because of how the whole electronic revolution is happening. But either way, the fact that this pays a monthly dividend currently at 5.5% while we wait, and if you can get an attractive buy-in opportunity, maybe if it has another 5% pullback or so, that could lift that percentage of dividend even higher, and that could give us even more money going into the future. Of course, any company that is not hitting earnings and has declining revenue and earnings does not look profitable, it does not look good. However, they do have positive earnings and revenue, and if they continue to try to invest more money into that infrastructure, it seems to be a fantastic company going 10 years down the road. Next is Bank of Montreal, and of course it's a bank. They just made that big massive purchase in the United States, which is fantastic. 3.7% dividend that is being raised up quite a bit, so it's not just 3.7. They raised their dividend up 25% over the past couple of weeks because of the fact that they can now raise their dividends, so that percentage is going to change. Their earnings quarterly have been beating estimates, which is fantastic. That's what we want. And then we also have revenue that is at an all-time high, and because they made so many cutbacks during 2019 and 20 because of COVID, they have now made huge record earnings, which is why they raised their dividend 25%, which is huge. Just like every other Canadian bank other than that, a National Bank of Canada, their stock before the COVID pandemic was literally doing nothing. But it crashed, it had a double bottom, and it has since rallied hugely. It's had a little bit of a pullback recently. However, so has the whole entire market, as we can see here. As we can see, they do pay a dividend, and that dividend does increase quite often, other than during the pandemic. Fortis is the next company that I kind of really like, and with it paying a 3.6% dividend, it's quite nice. And it's got some high volume as well. That's always a fun message. Anytime a company likes to increase dividends, it's always good. Anyway, so from there, they have increased revenue every year. They had decreased earnings in 2020, which was no real huge surprise, really. They've had 1 missed quarter, 1 meat quarter, and 2 beats, which is happy. What does Fortis do? Well, Fortis operates as an electric and gas utility company in Canada, the United States, and the Caribbean countries. It generates, transmits, and distributes electricity approximately to 433,000 retail customers in southeastern Arizona and 98,000 customers in Arizona, Mojave, and Santa Cruz counties, with an aggregated capacity of 3,200 megawatts. Why is this important? Why is all this information important? That just brings me back to the whole electronic revolution. Everyone's going to be getting electric cars over the next 15 to 20 years. What are the companies that are basically... Let's look back at the gold rush, right? Who were the people who profited from the gold rush? Was it the people who were looking for the gold, which for us would be the people who are essentially trying to find the cars and the companies that are going to be profitable because of this revolution, or the ones who supply what the revolution needs? And that is electricity. Electricity is going to be needed. If everyone right now went out and said, screw gas cars, I need to go get a Tesla, guess what? what would need to be changed? What would happen? We would have massive blackouts right now. There is not enough capacity in the electric lines, in the the hydro lines, for everyone to have electric cars today. This is why I say the idiot in Canada who controls the environment, who's the environment minister, is a total dumbass, because there is not enough capacity in the hydro lines right now, or producing capacity. This is what this company does. That's why this company is going to win in the future. Over the past 5 years, it's done quite well. It's gone from $40 up to $58 and topped out just over $60. It's going to continue to grow. It might have a little bit of a pullback potentially depending on the market, but it's going to continue to grow into the future. And they increase their dividends all the time. Earnings are not terrible, missed, meet, beat, yay. So overall, fantastic company. These are my thoughts on these stocks. Remember, do your own homework. Don't trust any random person online. I may seem trustworthy, but I may be trying to push some of these stocks. I'm going to tell you right now, I own the Canadian banks. I like them. I have way too much money put into the Canadian banks. However, at the same time, I'm trying to help you, but always try to do your own research. Never trust random people online. Any Bitcoin comments down below, don't trust any single one of them. Anyways, I hope that you've enjoyed today's video. If you have, hit that like button, subscribe, and I'll see you guys again next time.